It's break time once again. You make your way to the vending machine, but your card is declined. You reach into your pocket and find a handful of coins. You've got, what, $4.37 in there? Now sure, you could get yourself a snack and a drink, but have you ever considered putting that money to work for you? That pocket change? That's where portfolios are born, where your future is born. Now, when most people think of investing, they think it's only for rich people or day traders, the wolves of Wall Street, as it were. But the truth of the matter is that anyone can get started and start putting that pocket change to work for them. Here, let me show you how. An easy way to start is with roundup apps. Probably the most famous of these is Acorns. Apps like these take your purchases and round them up. So if you spend $3.60 on coffee, the app will automatically round it up to $4 and invest those extra 40 cents. Simple, painless, and an easy way to start. You won't even notice it's happening. If you're not comfortable with investing right this minute, Chime has a feature that rounds up your extra money and puts it into savings. Same idea, a simple unconscious decision that puts your money to work. There are even apps that let you create rules, such as investing $5 every time it rains, or round up every Uber ride. Almost a bit of a game that way. In the end, the best investments can often be ones that you don't even know you're making. Those little bits and pieces add up over time, and what starts as a few cents here and there can soon form the stepping stone into financial security. Now that we've started the process, let's take the next step up the ladder, going from pennies and nickels to $5 and $20 at a time. Say hello to fractional shares. These are less than one full share, allowing you to buy into high-priced companies for as little as a few dollars. Ever wanted to get into Amazon, Microsoft, or other stocks trading for hundreds a share? Well, here's how you can. The pioneer and most famous name here is Robinhood. They pioneered the use of commission-free trades and are one of the biggest players in fractional shares. While they're a little controversial, they still warrant a serious examination. You might also consider Fidelity Investments, which refers to the idea as stocks by the slice, which is just another way of getting into fractional shares. There are also apps that let you see what other people have been investing in, letting you take the wisdom of the public into account. Think about it this way. A single share of Google is over $300, but with $5 in a fractional share, you can get a piece of the company, one that grows over time. Now that we've gotten our toes wet and are starting to invest, the next step is changing our mindset. Here, we're going to go from $5 a month to $50 a month worth of investment. Now that change can make a huge difference in your bottom line, but before you start to panic or worry over the sudden jump, take a moment to look at what we're really doing. Instead of asking an app to invest pennies and nickels, we're simply looking at investing larger sums, and it can still do it automatically. Almost every major app or platform that we've discussed lets you set an investment schedule. Set it for once a month and forget about it. Let the app do the work for you. There are other options that not only auto-invest, but can rebalance your portfolio. Simply tell it your goal and your timeline, and it will do the work for you. Why is it so important with such low numbers? Well, $50 a month hardly sounds world-changing, but remember, we're in it for the long haul, not a quick buck. $50 a month at an average return of 7% annually makes for $60,000 over 30 years. And all it took was $18,000 of your own money. The rest? Compounding growth. Now that $50 a month doesn't seem so little anymore, does it? When you're ready, we can take the next step and start thinking about $200 to $500 a month. Here, we're not thinking about saving extra money, but actually investing. The key here is actually counterintuitive. Rather than picking stocks and trying to guess the market, we're going to play the market as it is. This involves investing in index funds. These funds track the 500 largest US companies, so when you invest with them, you're actually buying fractional stocks, but on a much larger level. You're investing in companies like Apple, Microsoft, Amazon, and more. A tiny piece for sure, but the solid and steady path to growth. Funds like Vanguard or iShares track the biggest and best companies, making for safer and more secure investments. One particularly effective way of doing this is target date funds. You start with the year that you expect to retire, and the money is invested to help make sure that you have the best return by that date. Early on, it takes more risks, but as your retirement year gets closer, it'll automatically shift into more conservative and safer investments. We're not trying to beat the market, we're trying to become the market. In the end, the key is time. Invest now. Someone who starts investing $100 a month at the age of 22 is someone looking at a much earlier retirement than someone who starts investing at 32, even if that person puts in more money. The decade worth of compounding money that the younger person invested is worth more than years of catching up later. Don't believe me? Take a look at NerdWallet's compound interest calculator. This will help you visualize just how much you could be making by starting your investment journey now. So we find ourselves back at the beginning, that vending machine and that loose change. Why don't we skip the snack for now and instead use that money to start ourselves on the road to financial success? By taking that small step now and investing it, you might be setting yourself up the path for an early retirement. Not because of luck, but because you decided to invest early. And don't forget, if you like this advice and want more of it, don't forget to like this video and subscribe to the channel for even more great videos.